Welcome to the Master Certificate in Technical Analysis. This is the video for Module 16, which talks about Forex and the application of the technical analysis tools in the foreign exchange market. Why the Forex market? Well, a great many people think that the Forex market is perhaps the best market ever to trade in. To start with, it's open 24 hours a day and 5.5 days a week. Basically, it is only open 5 days a week in every part of the world, so that when you take into account all the time zone changes, it is in fact around about 5.5 days, perhaps 6 days. But it is 24 hours a day because it's always open somewhere around the world. And in fact, you can see the effects of the different markets on the way the pricing happens. So that allows you to trade your Forex when you get back from work. Perhaps you can do it in the mornings if you're just making your money that way. It's just incredibly flexible. And of course there are no commissions. It's not about paying a broker. Even the cheapest brokers are costing a few dollars a trade, and someone can cost a whole lot more than that. But you don't have to pay any commissions with Forex. How do they make their money? Well, they make their money by charging you a bit more to buy something than later you can sell it for. It's called a spread, and you can see those when you go to the Forex websites. Another reason to trade Forex is the low capital requirements. You can open an account for as little as $5,000, and you don't need anything like that to place a trade. You have to be a little bit careful with this. The usual guidelines apply, and you really don't want to have a losing trade devastate your account. And with Forex you can have a margin call if your account goes down because of the way the price goes. So you do have to be very careful. Just because you can do it doesn't mean you should. If you do that to your account, you're not going to be in business for very long. And now we can know for sure which way the market, and no one can know for sure which way the market is going to go in any of these Forex prices. You will have a losing trade, but anyway, you can get started with a low amount of capital, and of course this is an advantage. There's another advantage in that it's a very liquid market. That means it's easy to trade, and you'll always find a buyer and a seller whenever you want to trade, and Forex is that liquid market. I think the last figure I saw was $3.7 trillion a day. Certainly it's a massive market. It's much bigger than any stock market. You know, if you're looking at the stock markets, you're probably looking at billions a day, so it's thousands of times that. So it's a huge market. That means that you can always trade, so liquid market is certainly an advantage. And it's always a bull market. Doesn't mean that your dollar is always losing in value and you have currency savings that always increase in value. No, this means that you can either side of the transaction. So if the dollar is rising, you can take the dollar side. If the dollar is falling, you can take the other side, and it's still a bull market. So it's kind of trivial for the words, but it's always basically possible to take the side that's going up. So that's another reason why Forex is so good. You don't have things like going short when it's hard to short and it's hard to sell, and brokers borrow shares and things like that. It's always a bull market. And this final advantage is the 100 to 1 leverage is typical. You can go up to 400 to 1, but this means that if you can gain a lot, you can also lose a lot very quickly. So you've got to have your head on your shoulders when you're using that amount of leverage, and be prepared when you're going to get out of a trade. It goes against you. But there's another reason. If you can start with low capital, you're trading $100,000. That's a lot of currency. So if there's $100,000 in leverage, you need $1,000 to do it. So be careful with it. It's an advantage if you make the thing work for you. So make sure that you're on the inside. Just a brief look here. There are listed in the module. We don't have to write them down or anything. But currency pairs. This is another great thing about Forex, is that you're only dealing with probably 6 major currency pairs. You don't have hundreds or thousands of stocks to look at. To look at the company financials and see whether they're forming any patterns or not. You just need these. these 6 pairs, these are the major currency pairs, and as you can see, the US dollar is one of them. That's because it's the world's reserve currency, and I think it's going to continue to be the world reserve currency. Obviously there have been some issues about it, and about the currency that's been printed now about the financial crisis. Again, it's the currency that deals with every major currency that's there. You can also get what are called cross rates, and these are the ones that don't involve the dollar. You see, you've got the major currencies, the euro, the pound sterling, the Swiss franc, but if the dollar is doing something funny, you may want to jump over and trade in the cross rates so they don't involve the dollar. And of course, the other thing you can do is trade in the exotics. They're not the major ones, they don't have the major following, although they have a variety of services for them. The exotics comprise all sorts of other things that you don't have to hear. The exotics comprise all sorts of currencies that you don't hear of much. Things like the South African rand and currencies like similar currencies like that. But with the exotics you get a better trend, probably get a little bit of more movement, and it's all very well spelt out. But looking at the technical analysis, and the only thing that you have to watch out for is the exotics, is that if there's a smaller government, then there can be a fallover of the government, and there could be some political things that happen. That's another choice you have when dealing in the exotics. Now, Forex is influenced by various things. Fundamentals we'll look at briefly, fundamentals that are reflected in the technical analysis as we learned earlier on. But just so you know, you can expect to be affected by fundamentals are the interest rates. Central banks of those countries determine the interest rates. If the interest rates go up, then that currency is more attractive to investors and international investors. So therefore, it's more in demand, and the value of the currency goes up. Trade deficits can have a big impact on the currency, because basically, if you're going into deficit and you're just spending more of your currency abroad, more than your currency coming in. So what you're doing is you're really just devaluing your currency. Your supply of currency to the world is more, and the demand is down because they don't need that currency in order to buy your currency. So basically you're devaluing your currency, and in the trade deficits you're running. Economic growth. As you would expect, whether the country is doing well economically really depends on whether the investors are investing in your currency, and obviously if the economy is doing well, there will be more demand for your currency and the currency will go up. Inflation, again, that's another factor that affects interest rates and how much money flows into the country. Political situation. This can happen around election time. This can be an important time for Forex. If you're looking at major currency, they are fairly steady, so it's really in the exotics where you might get an overthrow by the government that could really affect your trading. The political situation does play into it, but the economical situation is much more important. How the country is performing economically affects the currency. And then finally there's a psychology. As you know, trading psychology affects all the values. It's how the traders and other people see the market, and it'll affect that irrationally sometimes. So those are fundamental factors, and if you're looking at Forex in the long term, obviously those are very important. If you're in the short term, the technical reserves are going to be the thing you'll be looking at. And in technical, you can't use volume much, because volume around the world markets can't tell you how much volume is being traded, but you can use other things. You can use moving averages, moving average crossovers and things like that, and trends and trend channel lines, and those are appropriate as well. You don't get so much trending on Forex because the currencies tend to stay in relationship with each other, whereas stocks and shares, you'll find a country can be expanding and growing, generally increasing in value, and that will give you an uptrend. With Forex, it's fairly balanced between countries. You can't get long-term trends, but if you can spot trends, that it will follow trends fairly well. Support and resistance is perhaps more useful because support and resistance is horizontal, and therefore as currencies stay in the same general relationships to each other, that just goes up and down between the support and resistance, so you'll find plenty of opportunity to locate those. And because Forex is such a big market, it's not influenced too much by investors going in and out. You'll find all the normal technicals work very well. Fibonacci, the retracements, the 38%, the 62% retracements work well. So it's worth drawing some Fibonacci lines on your Forex chart if you see some retracement happening. Elliott waves again, wave theory comes into Forex because we've got a big market. You tend to obey the general guidelines of technical analysis. And of course, indicator divergences, the indicators you can put on there and see where they go in opposite levels to the price, then you know that something is happening. It's not a stable situation, it's going to change at some time. So you can use all these fundamental and analytical tools to trade the Forex, and again I will say just be careful, watch where your stock is and how much you're going to lose if it is going against you. If you obviously don't plan for it to go against you, you've got to be careful that you don't lose a lot of your account, and that'll quit you from trading in future. Now just a word of warning about Forex brokers. This is a different kettle of fish than stockbrokers. Forex brokers, they can be anywhere around the world, and it really doesn't matter with the internet, because whether they're whether they're in Canary Islands, British Virgin Islands, places where taxes may be non-existent or low, and may be enough for life for some people who work there as well. And you'll find, if you look for Forex brokers over the internet, you'll have them all over the world. This may or may not matter, it depends on how honest the brokers are, but preferably if you've got a broker who has got an office where you live or in the country where you live, then you can feel at least somewhat comforted that they'll come under the legal system if they'll do anything funny or strange. But Forex exchange has become so popular that there are some dodgy brokers out there, so you do have to do your research carefully and you have to look at reports. If there are any recommendations and complaints, you just go to the internet and you'll find all sorts of reports of scams. The broker stole me out of that, the broker didn't send me my money, I traded this much amount and have to make them all with a pinch of salt. There is a broker, and I won't name her, a broker based in New York, and in 2009 they got hauled up in front of the association because they were found to be putting lots of recommendations for themselves on the internet under different names. I think they're a pretty sound broker, but they're just finding the competition hard because there's so many brokers doing this. So that's the recommendation and complaints. If you get the complaint that someone scammed them and there's no really way to control whether that's true or not, the internet is an open information reservoir, and you've got to watch out for the complaints because you can get complaints against genuine companies. I saw one the other day that was a complaint, and it said that those people won't send me my money, and there was a response from them. They said, yeah, we'll send you your money, but we've got to send it back to the account it came from. There are many money laundering rules that say they can't launder money and send it off to other account just because you tell me you want it there. We're not allowed to send it there by international law. So people can complain because they lost money because they didn't really understand what they're getting into. So just because you see complaints doesn't mean they're a bad broker. Just because you see recommendations doesn't mean that they're good. There's one point about Forex brokers. You can have a dealing desk, and a lot of brokers work that way. They're the ones that will give you fixed spread, and sometimes you'll find that you're just literally dealing against the broker, and if you win, the broker loses. You can get. I've seen substantial reports of brokers with dealing desks stop loss hunting by trading a spike in the substantiated reports of brokers. By trading a spike in the price and trading people out of the trade because they put a stop loss with the broker, and so the dealing desk can work, but they are open to the dishonest broker fiddling them. The alternative is the ECN, the Electronic Communications Network, that gives you a connection through to the market, so you know you're not getting done. You will see a difference in spreads, in fact, as they're in pairs. And you may even see 10 big spreads rather than some sort of 2 or 3 that you're used to seeing. But at least you know you're getting the market prices. So that's a choice. If you've got an honest broker, a dealing desk is fine. But an ECN is another way to find a guaranteed way of getting yourself that you're getting the market rate. The other thing that you can do, depending on where it is check with the Better Business Bureau. Check whether the various trading associations, and check with government regulations. The licensing authorities, even if they out now if someone is licensing, they would do that trading workout. They would do that to the trading, so they should check with them. Go to the government website. That's one place I would trust on the internet, is when you would go on the government website and make sure it's a genuine government website. You will find out if there have been problems, if there have been hold-ups to answer for themselves or not. So again, you have to redo your homework. You're going to be putting a lot of money potentially with these brokers, and you would want to be able to take your profit out when you make profit. So don't trust anything you read on the internet, but do your research and try and double check everything. Another thing you can do is, even if the web says it's a local office, is try calling them. Make sure the name of the office is not some residential number. An office answering machine that's not good, unless of course it's middle of the night somewhere. The Better Business Bureau should have it. If there is a case of one broker claiming to have a US presence and things went wrong and they looked into it, actually that address they gave on their website is actually a residential address, a house that was in foreclosure, and they had nothing to do with them. But they gave people an American address, and they said, yeah, fine, great, we understand that they've got an American office and therefore we're covered. But they weren't, so you do have to do your research. So find a decent broker and you'll be fine. They say Forex is good from a level rich point of view. You just have to watch out for the potential losses. And it's also good as a liquid market, and it's also good because it does respond to technical analysis. So Forex is certainly worth considering for your trading career. The next module, module 17, we're going to be talking about contracts for differences and spread betting. This is not so much of an interest to the US customers because we can't do it. The SEC say we can't have these financial tools at the moment, but they're certainly very popular in the UK and Australia and in some parts of Canada and in many other places. So we'll be looking at the technical analysis particularly applied for contracts for difference and spread betting. So I look forward to talking to you again then. Goodbye for now.